So good morning. My name is James Bogart. I'm Managing Principal of Bogart Wealth. Thank you all for taking some time to watch the webinar this morning. Quick, just administrative item. I do have the question and answer section open. I also have the chat box open. So if you have any questions, I will do my absolute best to answer questions real time. And if not, I'll come back at the end and make sure that I address everyone. All right, so by quick introductions, again, I'm James Bogart, Managing Principal of Bogart Wealth. Bogart Wealth is a registered investment advisory firm. We are fully independent, true fiduciaries for our clients. And our core competencies, I'd say, are financial planning, tax optimization, and investment management. There are actually now 15 of us on our team. And I wanted to acknowledge our newest addition, Nell Cordick. She joined us last week, actually, as a financial advisor up in Virginia. We have 3 offices, one in McLean, Virginia, one in Houston, Texas, and one in the Woodlands, Texas. Our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. Many of you have heard me say it, but I can't say it enough. You know, your kids and your parents are some of the largest variables in any financial plan. We've made it part of our firm's culture to give your children access to certified financial planners. And I typically like to say, what would you do differently now that you know what you know, but maybe when you were in your 20s or your 30s? And it's important because most of them don't have the resources to talk to certified financial planners. And we can definitely have an impact early on. All right, so part of our why is to educate our customer base. And so we typically do 8 different educational events. One's the retirement planning timeline, one's retirement income planning, one's social security planning, one's tax optimization and tax planning strategies, one's on estate planning strategies, one's on net unrealized appreciation and post-retirement strategies, one's on long-term care and long-term care insurance, and then last but certainly not least is Roth versus traditional 401ks and IRAs. You know, these we historically have done as live events. I'm now pivoting to do them all as webinars. They will be coming out here soon. But in the meantime, we've been doing these kind of more timely ones. We've done 5 now via webinar and getting great success. But if there's a topic that you think is appropriate or would like to hear us talk on, please send me an email because honestly, I think the more timely these are, the more beneficial they are for everyone. And we are building out different events just based on things that we're talking about with our existing clients or prospective clients, and would love to hear more feedback there. All right, so today's talk, we're going to specifically talk about how to generate income in a recessionary environment. First and foremost, I want to talk about, you know, how is a recession going to affect retirement? Then we're going to talk about sources of retirement income, talk a little bit about Social Security and how it's designed to replace part of the income stream. Pension estimator tools. We're going to talk about some basic investment strategies for retirees, as well as asset allocation strategies, withdrawal strategies, and then I'll wrap up with questions and answers. And along the way, like I said, I've got the question and answer box open as well as the chat box, so please feel free to send notes and I'll do my best to respond. All right, so, you know, the ultimate question is, how will a recession affect my retirement? And I love this chart. I saw it a few times. I had to steal it. But this chart shows just the cycle of human emotion in relation to market movement as well. You know, and we start, we're at this point of optimism. We kind of peak at this point of euphoria. And then ultimately, when we see markets go into a more corrective environment, that's where more negative emotions start to elicit, and we ultimately get to a point of despondency, and then we start back up, depression, hope, relief, and optimism. You know, but human emotion absolutely can have an extremely material impact on somebody's ability, not only emotionally, but also financially be impacted through retirement. You know, and the point that I can't make enough is that emotions can absolutely destroy someone's plan. Fear and or greed can lead to buying high or selling low. And ultimately, having an investment process means that we need to have the discipline in order to be able to take advantage of whatever market environment that we're in, both when the markets are high or when the markets are low. And it's typically what we find is It's very easy to be greedy when fearful, very easy to be fearful when greedy, but very hard to be greedy when fearful. So the point is that human motion is wired wrong. We are wired as humans. We want to buy when things feel good, which is typically at higher price points. And we want to sell when things go down. And really what we're trying to get at is finding mechanisms to be able to reverse that psychology. Now, wanted to show this chart. Now, this is as of February 28th, 2020. So it's not totally factoring in what happened in the month of March. But the point is that if we look back for the last 40 years, we've seen historically 11 negative years over the last 40, and the rest of them have all been positive years, some more than others, obviously. But when we look back, even on the years that are positive, they had negative periods of time. And ultimately, too, the years that were negative, they had periods of time that were more negative than where they finished up. And I do think that, that's going to also be indicative of the environment that we're in right now. Obviously, March 23rd was the relative low that we've seen thus far this year, and we've had a nice little rally off that low. I do ultimately think that this is at least a bear market rally, and that we might potentially partially retest what we've seen. So be mindful of that. But at the end of the day, I do believe 6 to 12 months from where we are today, we're going to be higher than where we are right now. And it's important to remember that. And so, along those lines, and this is a chart that we took from PIMCO, but it goes back specifically talking about kind of the 2006 to 2010 era, and what some investors ultimately did achieve. And it goes to the point that market timing is absolutely impossible to do. And so, obviously, if you started in 2006 and invested, you had a nice little run up here, and you're very happy, euphoric that you made that decision. Then ultimately the correction starts to happen, and then someone says, well, this has to be, there has to be a recovery soon. And ultimately we hit that point of despondency where we can't take this anymore, and we make the decision to go to cash. In the short term, that might actually have been a good move, where you're really happy you did it. And then we start to see things turn and improve. And ultimately you start to say, oh, this can't possibly last. And by the time someone actually makes the decision to get back in, it's typically after we've seen a significant portion of the rally. And so just to kind of put a hypothetical $100,000 investment, that the investor that stayed all the way in, they actually, at the end of that period of time had $111,694, whereas the person in this example, that when they got out, ultimately they had $93,320. And so it's just illustrating the point of market timing and the danger that it can have, because even if we go to cash, and in the near term, it feels very good that we went to cash because it did go down a little bit further from where you went out. Ultimately, the point where people get back in is almost always higher than where they got out. And that's what ultimately causes the damage. Now, this is an interesting chart as well, going back the last 11 years. And you can see we've had a lot of reasons to sell over these periods of time, whether it's different fiscal issues, whether it's market-related issues, it's energy issues. And obviously, coronavirus, this chart's a little dated just because it doesn't show the full impact of coronavirus. But the coronavirus itself, it's a blip. It's a blip down, and it's absolutely going to be a self-induced recession. But the point is over history, we've got lots of reasons to sell. But when we look at this over an extended time horizon, again, 10-year period, 11, 12-year period of time, even these corrections that at the time felt significant ultimately were relatively minor. And kind of to build on that point, this is, again, going back dates dated as of February 28th, but this is looking at the S&P 500. And so those that stayed invested for the last 30 years up until the end of February 28, 2020, you stayed invested in the S&P 500. Your experience was 9.6% returns. If you missed the best 15 days, your returns dropped to 6.4%. If you missed the best 30 days, your returns dropped to 4.1. The best 45 days, 2.1. The best 60 days, you're almost flat at 0.4. If you missed the best 75 days, down 1.2. And the best 90 days down 2.7. And honestly, if we flesh out and include even the month of March, we've seen obviously some pretty significant down days, but we've also seen some pretty significant up days. And so it's important to be mindful not only of where your situation is, but also where we're using from different aspects of your retirement plan. And ultimately that builds into, what the talk is for today, which is, retirement planning is a process. It's not a one-time event. And so it's important to really understand where your baseline is, have a retirement plan, build that analysis out, but then also understand investment strategies, understand withdrawal strategies, and then have the ability to constantly monitor and review where you're at. So when we talk about how to generate income in retirement, it's important to understand the income sources that a retiree has available to them. And the first one we have to address is Social Security. Now, Social Security was never designed to replace 100% of anyone's income. On the low end, it's 90%, and theoretically, it's 0% if you have unlimited income. I'd obviously love to meet you, but for the U.S. median income, it replaces about 40%. For the typical ExxonMobil employee, we find that it replaces anywhere from 10 to 30%. Now, this chart here is actually showing the replacement ratios and what different dollar figures. So going back to that 90% replacement, if you're living on $11,520, you are able to replace 90% of your income with Social Security. If you're able to live on $69,420, Social Security is going to replace 42% of your income. And then if you live right on the maximum wage base, which is the maximum amount you pay into Social Security, which is $137,700, Social Security will replace 27%. And obviously that percentage gets smaller and smaller and smaller the higher your living needs are. So it's just important to understand that Social Security is a very real source of replacing your income. All right. Now, beyond Social Security, ExxonMobil households have their pension. Now, the pension also never designed to replace 100%. The annuity on the low end will replace 12%. On the high end, it will replace 65% of earnings. And the formula is very simple. It's 1.6 times years of service times average pensionable pay, back out a little bit of a Social Security offset, and that's what gives us the number. Now, the typical ExxonMobil employee, it replaces about 50% if you're retiring at the age of 60. So if you've got 60% being replaced, 50% being replaced by Social Security, by the pension, and then we've got another 20%, say, being replaced by the Social Security, well, that puts us at 70%. I don't know a whole lot of people who retire and want to live on less than what they were living on before they retired. Now, some neat little charts here. This is actually the legacy pension calculator that ExxonMobil used. The reason I like this one a lot is because it actually shows the formula right here. 1.6 times years of service times average pensionable pay, less the Social Security offset. This gives the single life annuity option. Right there, then we apply the discount rates, and that's what tells us what the lump sum value is. Very simple. Obviously, it's dated from 2007. ExxonMobil's got some newer tools available, web-based tools to help us with these numbers, but very, very mindful that the formula is exactly that. It's formulaic. Now, a lot of people ask us, just kind of depending upon age and service, where they're at with the maximizing their benefits. So going back to kind of the baseline group, this is the employees that are retiring right at 55 with 15 years of service. Well, as I mentioned, that's going to replace 12% of the earnings amount if you're retiring at that point in time. And if you're retiring a little bit after that, just again, this is assuming you're right at 15 years of service, it kind of maxes out at about 20% replacement of your income. So hopefully in that case, you've got other sources to be able to live off of. Now for the lifers, if you will, somebody, for example, that's retiring at age 55 with 33 years of service, well, so the pension's going to replace approximately 32 to 33%. And then we see the accumulated benefit of continuing to work. So between 55 and 60, you're actually going to continue to get about 8% per year. And the reason for that is because ExxonMobil imposes a 5% per year discount ahead of retiring at age 60. And you're getting about an additional 3% per year for every year you continue to work. So for example, somebody who's retiring after the age of 60, you're seeing about a 3% per year accumulation just by the increases of years of service. So to that point, where I talk about, let's just say the typical lifer has 50% replaced by the lump sum or the pension program, excuse me, and then we've got another 20% being replaced by Social Security. Well, that brings us to 70%. And if ultimately your desire is to not retire on less than what you were making before, we need to rely on outside buckets. This would be savings and any other type of investment income. Might be 401ks, IRAs, TSPs, et cetera. And then naturally, we need to build out a portfolio strategy associated with your respective risk profile. Now, I'm going to introduce just kind of what I call the 5 basic strategy or elements for investing a retirement portfolio. The first is using annuities, whether it's a fixed annuity, indexed annuity, variable annuity. Another would be using bond ladders. The third would be more of an income-oriented approach. Fourth would be more of a fixed asset allocation model. Fifth would be something that's a little bit more dynamic in nature, where we're making adjustments throughout the model. And by the way, my intention is not to make a recommendation of any one of these. It's purely to educate on the different options. All right, so when we talk about annuities, there's 3 types of annuities: fixed annuities, indexed annuities, and variable annuities. Now, the easiest to start with is fixed annuities. Fixed annuities, by and large, think of them like bank CDs. It's fixed. Your money goes into a general fund pooled with other employees, and then at that point, with other investors. And then at that point in time, you get a predetermined rate of return. So like, for example, a 5-year fixed annuity right now is paying about 2.2, 2.3, some of them are as high as 2.7%. Now, on the flip side of that is variable annuities. Easiest way of describing these is think of these a lot like mutual funds. They are, the annuity companies love to position them as mutual funds with airbags because it's an insurance product. But you are going to have market-like rates of return. They're invested in sub-accounts, and each investor's money is segmented in its own separate account. And then in the middle is what are called indexed annuities. Now, indexed annuities are essentially a hybrid of fixed and variable annuities, where they're designed to give you a percentage of performance of some underlying benchmark on the way up, but cap out or provide some level of floor on the downside. And they are also part of the general fund. Now, with all of these options, you can add on income riders, you can add on guaranteed performance riders. The big negative I would say with annuities in general is that they're typically very high in cost. And what I have found with a lot of investors who are considering, or it's very appropriate to have an annuity, the ExxonMobil one is not a bad option. And since they've actually deviated prior to, I believe it was 2011, you had to do 100% annuity or 100% lump sum. Now you have the ability to do 75% lump sum, 25% annuity, 50-50, 25-75. So, and then within the annuity options, there's a lot of different categories as well. I do think that if annuities are something we want to consider, that is a viable option. But ultimately, if we go with the ExxonMobil annuity, the big risk there is that there's no cost of living adjustment. And I am concerned, especially given the level of fiscal stimulus we've had over the last couple of weeks. Our deficits are higher than they've ever been before. And ultimately, we are going to have an inflationary environment. And so I do believe that if we're going to have, if we are going to go with the annuity option, we need to have other investments in there to be able to offset the impact of inflation on your overall portfolio. Someone just said they think it changed in 2016. Yeah, but either way, they did change it so that it isn't 100% or not. I agree. There was one other question. Do I foresee ExxonMobil laying down the pension given that it's an outlier to retain a pension? Understand that this is your personal opinion only. I don't see ExxonMobil getting rid of the pension program, nor do I see any of the energy companies getting rid of the pension program. And the math to determine how pension programs, lump sum programs are being calculated is determined based upon the Pension Protection Act of 2006. Ultimately, you're right, it is a perk, a benefit. I don't see them getting rid of it. It would be hard for me to imagine that. But I will say, to your point, the energy companies in general are going to struggle, especially if crude prices stay here at $20 a barrel. It's very hard for them to make money there. That said, that's a rabbit hole we could go down for a long time. If they did make any change to the pension program, I think that they obviously have much bigger issues. I do think that they'd also give lots and lots of heads up before that happening. But I just don't see it happening. All right, I want to give a basic example of a bond ladder. Now, bond ladders are where you would buy individual bonds. And so, for example, this is just showing you a 3-rung, 3-year bond ladder over a 6-year period of time. So let's just say you've got $300,000 to invest, and you wanted to keep it more conservative, focusing just on getting coupon payments of the bonds. So you might actually buy a 1-year bond for $100,000, then you'll buy a 2-year bond for $100,000, and then you'll buy a 3-year bond for $100,000. As the 1-year matures, you buy a new 3-year. As the 2-year matures, you buy a new 3-year, and you essentially keep laddering it out. The whole point of these is that you're very confident in the bonds that you're buying, and that you're relying on the interest that's coming in off of these bonds. I will say that bond ladders have not been extremely popular as of late because interest rates have come so low, and it's very hard for investors to live on some of the lower level of interest that's coming in off of them. As an example, and I recognize some of these numbers are slightly dated, but the point is that bond ladders, shorter term bond ladders are paying about 2.5%, and a very long-term bond ladder is paying about 5.4. So huge delta in terms of duration. But what this means is a short-term bond ladder would typically be 2 to 3 years, for example. A long-term bond ladder would have a lot of 30-year bonds in there, and that's how you get that higher yield or higher rate of return. And just as a comparison point, to show you what corporate bonds are at, AAA rated corporate bonds about 2.7 versus high quality non-investment grade or somewhere around 3.6. Flexible income funds or income bonds are about 6.4. Mortgage bonds are 2.2 out to 2.7. International bonds are 0.3 to 1.6. Preferred stocks are at 6.8. Royalty trust or limited partnership investments are about 7 to 19%. Dividend paying stocks and high quality stocks with what's happened recently. ExxonMobil is an example of that. I'd argue still a high quality stock, but you're seeing dividend yields, up towards, at one point we're up at 11%, which is crazy to me. But you can get high quality stocks that are still paying very good dividend yields, 3 to 10%. And all of that compared to the treasury, and at the time it was at 0.8, the 10-year treasury was at 0.84. So the point is that income is hard to find now in the bond environment. And I don't know a lot of portfolio managers that are willing to take on a tremendous amount of interest rate risk on the fixed income side, because there is an element as interest rates rise, the value of those bonds goes down and they move inverse to each other. So we are concerned that with interest rates at such a low level at some point in here, which it could still be 2 to 3 years away, at some point in here, interest rates are going to rise and it's going to cause an erosion of the underlying value of those bonds. So just something to be mindful of. Now I wanted to introduce you to just one strategy. This is an illustration that Pete put together that's comparing ExxonMobil stock to our prime income portfolio. And truth be told, it only goes through the end of 2019. But the point really is to illustrate that there is the ability to get very diversified and get a dividend income stream that is not only as consistent, but not maybe even better from a percentage basis relative to just maintaining one big position in ExxonMobil. Now, I will admit, recently, because of what ExxonMobil stock price has done, it's been a lot easier to get customers to sell ExxonMobil stock. But up until the end of 2018, early 19, it was very difficult to get employees to sell stock or retirees to sell stock. But what we're trying to illustrate here is just the history of prime income versus ExxonMobil stock. And this goes back to 2000, so it's a 19-year time history. Started with a hypothetical $100,000 investment. And prime income, you can see it's volatile and continues to rise over the last 19 years, whereas ExxonMobil stock, well, it's not exactly risen. But a lot of people will say to us, well, ExxonMobil's dividend's really, really good. I'd say, yeah, I agree with you, but why not be diversified? And why not get into a portfolio of stocks that is more diversified than just being in one stock. What is meant by prime income? Prime income is just one portfolio that Bogart Wealth manages. I'm using this purely as an illustration to show you that you can still get great dividend paying stocks without having to be just in ExxonMobil's stock. And again, it is based upon historical numbers, but it's a hypothetical illustration. And so, we look at ExxonMobil's dividend payment, which it's grown at an average of 6.2% over the last 37 years. But if I compare that to prime income's dividend payment, and again, going all the way back to 2000, that's grown at an 8.2% rate during that same time horizon. Now, honestly, if I put 2020's numbers in here, it actually makes prime income look even better. At a relative point, ExxonMobil was down 63% intraday at one point this year. Prime income, obviously not immune to volatility, it was down about 29%. But at the same time, too, for a portion of a person's portfolio, to illustrate the point of why would I be in ExxonMobil stock, one stock, versus being in a diversified mix. Now, prime income year to date is now down 18% roughly, whereas ExxonMobil stock is still down well over 48%, I believe is the number as of this morning. So still down less than ExxonMobil. But the point is, consider being diversified. All right. I want to talk a little bit about more of what we call modern portfolio theory, asset allocation, and more of a stagnant model approach. And the concept here is that if you have a portfolio that is 100% stocks all the way out here on the spectrum, you're going to have more risk, but better overall return. If you have a portfolio that's 100% bonds, you're going to have less risk, but less overall returns. And so the whole concept of modern portfolio theory is that if you combine the two, where you can have a portfolio of 40% stocks, 60% bonds, or 50-50, or 60% stocks, 40% bonds, you can get a better overall return with less overall risk. And so, the only challenge I would make with a asset allocation model or a stagnant approach is that, especially in a down market, if we're relying on that for cash flows, then it's absolutely going to be an issue because you're having to liquidate a portion of the portfolio in a down market. And I'm going to talk about withdrawal strategies and liquidity strategies in a minute, but that's really the only challenge I would make here. I do believe modern portfolio theory, just more of a passive approach, indexing, is a great strategy when you're in the accumulation phase of life. I don't necessarily think it's a fantastic strategy for those that are retired and needing to rely on their portfolio for income. All right. And then the last strategy we want to talk about is dynamic asset allocation. And the concept of dynamic asset allocation is that if we look back in history, in the early part of the 20th century, railroad stocks represented 63% of the US equity markets. Now it's just 0.2% a century later. Russia, India, Austria, Hungary together represented 25% of the global equity markets in 1899. Now it's less than 1% over a century later. So the point is that things change. The market environment changes. I can even make the same comment about ExxonMobil stock. 90s, early 2000s, ExxonMobil stock did really, really well. For the last 12 years now, it really hasn't. And I think a lot of it has been just a shift in supply and demand. But I also think it's because of increasing technology that's made energy exposure a little bit more prevalent. So it's, really, as we've seen supply increasing, the demand's gone down. It's kind of been a double whammy effect with regards to what's happened with ExxonMobil. But if we also look at history in here, we see that there are periods of time where we get significant multi-year declines. 2007 to 2009 is the most recent example. 2000 to 2002, another example of that. Then we have to go back to the 70s prior to that. And so as you're looking at your portfolio approach, I do believe that just a pure static approach, especially in an environment like we're in right now, might not always be the most prudent, because as we see the areas of the economy that have been impacted more, well, I could argue that it might make sense to start shifting into areas where we believe are going to rebound faster, whereas I'm maintaining exposure to areas that are clearly going to have more of a struggle because of the economic impact that's happening right now. So dynamic is really more of a process. It's not trying to time the market by any means. It's based on actual trends, not predictions or beliefs. And it's looking at the flow of funds that's created with market prices and trying to factor in geopolitical concerns, economic upturns, downturns, industry or sector updates, anything that's going on with interest rates. But what it's doing is it's ranking and scoring assets versus each other. So you might look at large cap growth stocks versus small cap stocks versus international stocks versus cash. And it's ranking them all relative to each other. And based upon how they're performing on a relative strength basis is where you would place the bias. So for example, right now we're in a recession, or if we're not in a recession, we're absolutely going to be in one. Arguably, it could be a more deep initial recession based upon, I think ultimately we could even be at depression level numbers, but given the level of stimulus, I think we're going to come out of it pretty quickly. But part of the economy that does not perform well when we go into a recession is small and mid cap companies. Most of them have had to completely shut their doors. Some of them aren't going to have any level of revenue for months. And ultimately, I'd say that's an area that we want to be having less exposure to in the near term, because it's going to be a little bit longer before those types of companies come back online, as opposed to ones with bigger balance sheets that are able to weather the storm a little bit better. And so the concept with dynamic is that ultimately, if you think of the market in a big wave, we're not trying to sell or move out at the high. You wait for a confirmation of trend, and that's where you ultimately start making adjustments. And the same goes as things start to bottom out, we're not going to wait and try to buy back in at the absolute low or be speculative there. We wait for a confirmation of trend, and then we start to reallocate or reshift the allocations as we've seen things start to improve. And ultimately, the point is we want to make sure that we're in less risky areas on that drawdown period of time, and then taking advantage of things as they start to get back on track. And this market cycles just ultimately shows there is never any one period of time where every single asset class is the top performer. If you look at history going back to 2001, different parts of the economy perform at different periods of time better than others. And so we want to be able to be flexible enough to mitigate between as best we can in different market environments. Question here is, how do you feel about international versus US large caps or small caps during this recessionary period? I do think that this is a multi-pronged question, international versus US large cap and US small caps. I do think that international companies are going to come back online a little bit faster than US companies, mostly because they've experienced COVID-19 earlier than we did. But I think that the US is actually much more significantly positioned to recover faster long-term. The US, I mean, obviously bias, I'm American, but the US does historically has shown that we have the ability to adapt to change faster than most others. The resources as well as the ingenuity to be able to make pivotal changes in different environments. So I personally believe, as we talk about where the economy is going to get back on track quickest, it's going to be with US large cap companies. I also think it's going to be specifically with US large cap growth companies. Take, for example, a lot of the tech stocks. Most of them weren't as negatively impacted on the way down with this recession. And I do ultimately believe in this stay-at-home economy. A lot of them are still doing really, really well. Look at, like, for example, the video game companies. Gosh, I mean, they're doing extremely well right now. I mean, that's taking out companies like Zoom or any of the virtual work from home solutions. So I think ultimately US large cap growth is going to be where we're going to see the initial phase of the recovery. Yesterday, at one point, the NASDAQ was actually positive for the year, interestingly enough. So, I mean, I do think that they were less impacted on the way down. I do ultimately think they're also going to do the best on the way back up. And then to my comment on small caps, I do think that it's important to still maintain some level of exposure because you never ultimately know. But if we're in a recession, which I think most of us would absolutely agree we are, it's hard to argue we aren't. But if we're in a recession, then very high probability that small cap companies are going to get hit the hardest, which we've seen that in terms of their performance, but it's ultimately going to be a little bit longer before they get back on track. And so just something to be mindful of with overall asset allocation. All right. And by the way, with every one of the 5 approaches that I just talked about, there's risk with each of them. The risk with dynamic is that if we see a perfect V-shaped recovery, you've moved to reducing your risk or your exposure, and then all of a sudden we see a significant recovery happen very, very quickly, then there's a potential that you could miss out on some of that bounce back. And we saw it in 2015, we saw it in 2016. And that's why I ultimately think when we talk about portfolio design and asset allocation, it's important to have diversification within your portfolio, but it's also important to have diversification with your strategies as well. So nice segue into asset allocation. But we want to look at what your current asset allocation is and adjust according to your risk profile and investment goals. Most active employees only look at their 401k and they see, how bad that's performed year to date, but they typically forget the value of that pension / lump sum when we're looking at their overall asset allocation model. While you're actively employed, there's not a whole lot we can do in terms of adjustment with regards to that pension lump sum. Obviously, it's stuck in there. So remembering that even though your 401k might be more heavily weighted in stocks, you got to incorporate the value of the pension lump sum in your overall asset allocation model. And I think when you look at the other side of it, you obviously need to have a much more diversified approach. Now, with it, we need to understand withdrawal strategies. And if anything, this market environment really emphasizes that. And we need to understand how are we going to deliver that paycheck. Now, some people are going to be in the fortunate position that they can be essentially income only, means that they're only going to be withdrawing interest and dividends from their investments. For example, if you own ExxonMobil stock, you just got ExxonMobil dividends coming in, you're going to be fine, right? And I'd say ultimately that's not probably the vast majority of us. But I do think that there will be some people who are able to just solely live on dividend and interest from their investments. The second approach that we commonly talk about is more of a bucket approach, where we create specific portfolios for short-term goals, for intermediate-term goals, and then for long-term goals. And then the last strategy that we can talk about is more of a systematic approach, that no matter what's going on with the markets, if they're up, they're down, we're just taking a pro rata piece out of the portfolio along the way. And so here's an example of what I call the bucket approach. And I personally am very biased. I like the bucket approach because I want to know where my cash flow is coming from. But let's just say you've got a $1.5 million portfolio and you need $60,000 a year. Well, I want to keep anywhere from 3 years to 5 years in a short-term parking place stable. I know where it's coming from. And in this example, it'd be, about $300,000. And some examples would be cash-like investments. It might be some high-quality short-term bonds where I don't have to worry about what's going on right now. I do think that we're not out of the woods yet. And that's why I made the comment that this environment is really, really important to think about short-term liquidity needs and knowing where your paycheck is coming from. And then in the second tranche, we call it bucket 2. This is where we can put more income engines and maybe think of it as the 6 to 12 year money, where again, let's just say that we need $60,000, $70,000 here. Well, now call it another $500,000. This is going to go into high quality corporate bonds. This is going to go into big dividend paying stocks where we're having income that's replacing what we're spending off of bucket 1. And then the remaining money is where we can take risk. This is where we've got more diversified growth exposure, but recognizing if we have this type of approach, the bucket 3 is the one that's going to be impacted the most with the volatility. But if I know where my paycheck's coming from, I can sleep a lot easier knowing that if the long-term money is still continuing to do what it's doing, I'm going to be okay. And ultimately, that's the number one question that I'm getting from clients right now is, am I going to be okay? I think it's important to constantly be incorporating your financial planning needs in here. And that's exactly why you need to go and have a process for reviewing and monitoring your progress along the way. You want to understand, are your assets higher or lower than where we projected them to be? Was your income estimate correct? Did you receive any unexpected cash inflows or were we short anywhere? How was your spending? That's one of the biggest variables I see in any level of financial plan. Going back to those buckets, if we're assuming you're spending $60,000 a year and we planned for that, but all of a sudden you're spending 100, well, that's obviously dramatically changing what we were setting up the asset allocation to be. And then we look at the portfolio. Was your portfolio returning higher or lower than what we anticipated to be? And do we need to do any type of adjustments in strategy? Has your risk profile changed? Then we need to look at the overall withdrawal rate. So has it fallen below a level of success within a portfolio structure? And then inflation, do we need to increase for inflation? I would say that inflation is a very real number. We have to make some level of assumption. I think in the short term, we might not see that, but in the long term, we absolutely will. And then obviously making any level of adjustments associated with goal changes, timing changes, et cetera. Yeah, so that's kind of the high level approach. So some things that we want to talk about now, and kind of action items from here, so I can wrap things up. You need to have a plan. Create a budget, understand your cash flow needs, and anticipate any future expenses. But we also need to understand what your long-term risk profile is. If your goals and time horizon have not changed, your investment portfolio should not change. Now, I'm not saying what's in the portfolio shouldn't change, but your long-term risk profile should stay intact. Making decisions out of fear or greed is absolutely not an investment strategy. I also think it's important, if you're still actively employed, don't stop saving when the markets are down. If anything, increase your savings, do more if you can, get more into the buckets, especially while things are down. Because I ultimately do think that we will get back on track, and it's going to look like a big U. Any investor who's sitting on cash now, 12 to 18 months from now, is going to regret not having that money otherwise invested, assuming they can take the risk with it. Some of the other points that we've talked about with clients in the near term is consider some tax loss harvesting. Also consider converting tax paid to a Roth IRA, or converting portions of your IRAs over to Roth IRAs. And if you were going to otherwise do it later in the year, maybe consider doing some of it earlier in the year while the accounts are down, because money that gets into a Roth, it'll grow tax-free from this point forward. Interest rates are also still very, very low. Let's consider refinancing any existing debt. And then if you haven't heard from your advisor, then maybe they aren't necessarily the best advisor for this type of environment, and maybe for your long-term needs. So that's all I had for today's presentation. We've got another one coming up next week. But one of the offers we have, because we do have some prospects on the line, Bogart Wealth does financial planning, and there's absolutely no cost, absolutely no obligation. If you'd like to just do a review of your portfolio or your current financial situation, we will give you any recommendations necessary to be able to look at strategies associated with any adjustments that you should be making along the way. I did just get a question that came in. What's a simple example of tax loss harvesting? A simple example of tax loss harvesting would be, let's say that you've got some shares of ExxonMobil stock that's sitting in a brokerage account. This would not be what's in the 401k. It would not be what's in an IRA. But let's say it's sitting in a brokerage account. And let's just say you bought those shares for $100,000, and today they're now down to $50,000. You've got a $50,000 loss in there. Well, maybe we can consider selling those, harvesting the $50,000 loss, take the proceeds, and get it into something that we think is going to bounce back faster than ExxonMobil stock will, or even maybe something similar in comparison to ExxonMobil. One of my other presentations I did got into the details of tax loss harvesting, and I'm going to be doing that one again for sure, but that's a quick example of it. So would absolutely love, if you haven't taken us up on the opportunity to do a financial plan, please feel free. Here's the contact information for some of our advisors. And I know Mindy's going to follow up after this. If you have any questions, we are recording this event, and I'll also include the slides. If you'd like to get a copy of the presentation, please feel free, let us know, and more than happy to send it out. That's all I had for today. And again, my email is just jbogart@Bogart Wealth. If you'd like to send me a question directly, I'm more than happy to do that. And I had one more question. Do the buckets consider Social Security income to retirees going to receive? Yeah, so the idea with the buckets, by the way, going back to that slide real quick, is we obviously will adjust what needs to be in the buckets based upon income streams. So maybe it's Social Security, but maybe you decided to take the pension program. Well, if you need $60,000 a year to live off of, and we've got, let's just say, $30,000 a year coming in from the pension program, well, then we can obviously drop the amount that's in bucket one. So we would drop it down in that example to 150. And throughout your life, obviously you might retire before you take Social Security income. So maybe we need to have a little bit more cash reserves early on in your retirement, and then we can transition or reduce the amount of cash reserves a little bit later, as an example. Great question. All right, I'm going to wrap up. Thank you for joining today. Please stay safe, stay healthy, stay well. And if there's anything we can do to help, please feel free to reach out.